All right, so welcome to this morning's program, Socially Responsible Investing, Is It Worth It? My name is Kyle Hubbard, and I'm a member of the philosophy department here at St. Anselm College, where I teach courses in ethics and business ethics. And I also serve as the program director for the Center for Ethics in Business and Governance, which is hosting this program. So today's program is the latest installment in the Ethics and Governance Speaker Series. The Ethics and Governance Series is a program of the Center for Ethics in Business and Governance, a center whose mission is to enrich the knowledge and practice of principled ethical decision-making by addressing important societal and organizational issues through collaborative discussion, research, and education. In light of this mission, we are particularly excited for the discussion today on socially responsible investing, because how we as individuals and organizations handle their investments can have a profound impact on our communities, for both better and for worse. Funding for the Ethics and Governance programs comes from a $2 million endowment created by the New Hampshire Secretary of State's office and the Center for Public Responsibility and Corporate Citizenship, awarded to St. Anselm College in 2013. The endowment was created from a settlement reached between the New Hampshire Securities Bureau and Tyco International Limited in 2002, and is administered by the University of New Hampshire Foundation. So we thank the foundation. For those who might be younger and don't remember 2002 as well, the Tyco was kind of one of the larger corporate scandals around the time of Enron. So joining us for today's panel discussion are two leading experts in socially responsible investing, both of whom have a wealth of individual experience in the field, but they are also both members of organizations that have been long-time institutional leaders in socially responsible investing. Our first guest, I'll welcome to the stage, is Anthony Eames. Eames, sorry. I forgot to ask you. Anthony Eames, Vice President and Director of Responsible Investment Strategy for Calvert Research and Management, a wholly owned subsidiary of Eaton Vance Management, specializing in responsible and sustainable investing across global capital markets. He joined Calvert Research and Management in 2016 when Eaton Vance acquired the business assets of Calvert Investment Management, forming Calvert Research and Management. I think I got that straight. Yeah. Anthony began his career in the investment management industry in 1995 with Calvert Investment Management. Our next guest is Aimee Forsythe, Senior Vice President, Portfolio Manager for Cambridge Trust. Aimee co-manages the Sustainable and Responsible Investment Strategy, which integrates environmental, social, and governance factors with traditional fundamental analysis. She joined Cambridge Trust in 2004. Moderating our discussion today is Mr. Mike Nikitas of Nikitas Communications. Mike has interviewed countless newsmakers in 36 years as a news and business anchor. Additionally, he's an adjunct professor of media strategy and skills at the Carsey School of Public Policy at the University of New Hampshire in Durham. So please join me in welcoming our panel to the stage.
Thank you for having me. Well, good morning, everybody. Great to be here in this historic room, St. Anselm College, New Hampshire Institute of Politics. Thank you, Dr. Hubbard. I know it was tough for you to sort of spit out the words University of New Hampshire, Carsey School, but it's a pleasure for me to be here, and I'm so excited to be here in this historic room. Many of the people who are running for president are more focused on socially responsible policy, public policy these days. It's interesting to see how the private sector has moved into the public sector in that area. So our focus today, once again, socially responsible investing, SRI. So Thanks to my guests, it's good to have you both here. Maybe we can start, and I thought we would start just with your 30,000-foot view of how we got here, where we are right now, and how do you sort of define, because everybody has a different definition, socially responsible investing. And maybe we could start with you, Anthony.
Sure, great, thank you. It's great to be here. Really appreciate this opportunity. I think what you have is really an evolving definition. So socially responsible investing really has its roots, I think, in sort of the contemporary sense back to the 70s. In fact, another New Hampshire-based company, PAX, in Portsmouth, I think is credited for launching the very first socially responsible fund back in 1971, partly as a reaction to the Vietnam War and not wanting to invest in companies that were sort of profiting from war. And the tools that we had at Investors back in those days was really focused on sort of an exclusionary approach. We didn't have the benefit of a lot of analysis or insight into how companies were managing their ESG, environmental, social, and governance performance factors. ESG wasn't even a thing back then. I think it was attractive to investors who lived their lives in a very particular way from a values perspective, from a beliefs perspective, and they saw socially responsible investing as a way to economically express those priorities in the investment context. Managers, in terms of investment managers at the time, would simply exclude companies based on a set of sort of sin stock criteria: tobacco, alcohol, gambling, nuclear, et cetera. But things started to change within the last really 10 years. In 2011, only 20% of the S&P 500 companies issued some sort of a corporate sustainability report. As of last year, almost 90% of S&P 500 companies are issuing these reports. And they're issuing them because investors are demanding. They're expecting to see how companies are managing what we describe as sort of non-financial factors, non-financial capital, but is increasingly related to financials, companies' financial performance. So natural capital, the use of natural resources, and then the emissions and the externalities that come from that use. Human capital, how are companies managing their employees, their global supply chains, their product safety issues, their data security issues, and then how are companies managing their governance capital, which is board diversity, board independence, executive compensation, auditing controls, et cetera. And so now we as investors have many more tools, much better data to truly assess how companies are managing these issues, and that allows us to build much better portfolios for our clients. We're still able to, I think, satisfy those sort of values-oriented investors that saw this as a way to economically express those values, but we're seeing what has emerged, and part of this is demographics, is that there is really a profit-seeking investor that thinks that companies that are doing a good job of managing those non-financial capital factors are increasingly well-positioned as just competitive companies to begin with, profitable companies, and companies that you want to have in your portfolio.
All right, Aimee, from your corner of the universe, he works for Eaton Vance, and you work for a bank.
Yes.
And approach it a little differently. So from your perspective, your corner of the universe, where are we now? How do we get here? And what's your take?
So I would say that when I first started working in the investment industry, it was very simple. When we had a client that was interested in SRI, which we termed at that point socially responsible investing, it really was more about environment. We don't want exposure to oil. We don't want to, we want to think about recycling. And so we did a lot of much more exclusionary type of portfolios where we would just simply exclude one sector. What I have found over time is that as data has become more robust and more prevalent, our portfolios have become much more customized and much more wide-ranging. So now we look much more at social issues. Much as Anthony said, we're looking at how a company is operating in the communities that it's in. We want to see how they're treating their employees. And also we look a lot at the governance side to see how a board of directors is doing, how executive management is doing. We look very heavily at diversity, so we look to see how many women are on the board, how many women are in executive management, and so that's something that we have much more of a focus on. I think SRI is definitely very mainstream. Most money managers now have some product offering that is an SRI type of product. I think some of the challenge that investors really face now is the prevalence of offerings. It's really exploded in the last few years. There's a lot more mutual funds and exchange-traded funds that focus on SRI, and I think investors in particular need to think carefully and really get under the hood to look at the investment process that's happening so that they can be sure that they're getting an investment that really aligns with their values and what they want to see.
Let me interrupt you on that. So how do you do that as an individual investor? How do you ferret that out? How do you vet it so that I know that this company's not just checking the box, just not greenwashing its strategies? How do you do that? And tell also how you do that as part of the process of choosing investments.
So we look at it from two sides. The first is we look at it fundamentally because we're being hired by our clients to manage their money and to grow their assets. And so we want to be sure that any investment that we invest in does have some potential for growth and is going to be a sustainable company going into the future. From there, we also look at environmental, social, and governance parameters. And it can be challenging because every sector is different, every industry is different. So one company, the environmental factors that you look at, they may be very different from a company in a different sector. So we want to get under the hood and see, are ESG factors throughout a company's operations? We want to be sure that it's not just a very fancy CSR report that's very nice marketing, but we want to see that there's actual meat on the bone, that we like to see things like employee-created environmental programs. I was recently looking at a company that does a very large recycling program that was created by its employees, and so that's something that's very favorable. We want to look at socially, how are employees treated? You know, we hear a lot about Amazon being a company that's not very nice to work for, and so that's something that we would consider as we're looking at those investments. And then on the governance side as well. We look at it in part too for risk mitigation because we often think that ESG factors can help show some red flags that could potentially show some problems going forward in a company.
Anthony, how do you do that? How do you vet a company and make sure that this fits the criteria, is not just greenwashing its strategies?
Right. It's a great question, and I mean, there's the 3-hour answer, and then there's the 30,000 foot, and I'll choose the latter for everybody's benefit. But so I talked about now we're in a better place now because there's more data that we have available to us. But just more data is not necessarily better, right? There's a lot of noise in the data as well. And so we've done a lot of research looking at the intersection between financial performance and corporate responsibility. We've done a lot of this research internally. We also have a joint partnership with a professor at Harvard Business School, a fellow by the name of George Serafeim. And if anybody's done research on CSR and responsible investing, you've probably come across George. He's one of the most popular professors there because he teaches all these classes that are so, so in vogue right now. What we have found through this research is that to just evaluate companies' management of their social responsibility, that doesn't necessarily help with performance. What you have to get to the bottom of is what is financially material from an ESG perspective for that given company. And so we literally isolate the E and the S and the G down at the sub-industry level. So there are about 200 sub-industries. I think the GICS classification system has 157. We pick another 40 or so. The idea is to isolate an industry and say, okay, what are the most material issues? If you're a mining company, then your impact on the environment is potentially financially material to the company. Workplace safety issues is financially material to the company. But if you're looking at a bank, the environmental impact is not important at all. The energy use of a bank is just the buildings that they operate out of. Management of data security, customer data security, and the stewardship of that, that's critical. Cross-selling issues, like a big West Coast bank has experienced recently, sort of product safety and suitability, and how are employees taken care of? Because frankly, with a financial company, it's the employees that are really the value of that company. So we isolate these ESG issues, and then we put a lot of emphasis on those issues. And then we source the very best data that we can. It's not relying on a single data provider. It's using really the best data that's out there. The good news is there are now dozens of companies that produce ESG data. They collect data from companies, and they make that available to us as investors. Sometimes we actually have to source our own data because we think that none of the data providers are doing the best job. We actually developed our own key performance indicator for data security. specific to the IT industry, because we didn't think any of the data providers had really the right set of data there. So we bring all this in, and ultimately we actually score companies. There's enough data out there now that we actually have a metrics-based approach. So we score all the companies in a given sub-industry, so we're comparing companies with the scores. It allows you to do two things. You can compare companies across the sub-industry, so you can isolate the companies that are doing the best job of managing these issues, also isolate the companies that are doing the worst job, and there was more risk in those businesses. We're obviously going to build portfolios around the companies that are doing the best. And then it also allows you to follow a company's performance over time, because it could be that companies that have improving ESG performance, that there's an alpha. That's industry jargon for outperformance is alpha. That could be a signal that that company might outperform other companies in its industry. So only with this advent and proliferation of data have we been able to build this metrics-based system, and it allows us to build an investable universe that we can then build portfolios for our clients.
What happens when you find a company that's bending the needle on the ESG metrics, but not so profitable, and you're comparing it with a company that's bending the needle on profit, but only a much less on the socially responsible side? How do you choose?
Yeah, it's a good question. So across our suite, so we've got a number of different strategies, and we actually manage both index strategies and actively managed strategies. And so for the indexes, all we're evaluating is the ESG performance. We're going to take a universe of companies. The Russell 1000 is a common index in our business, and so it's roughly the largest 1,000 companies by market capitalization in the United States. And when we apply this sort of quantitative ESG performance analysis, we come down with about 750 companies that are doing the best job. So those are those top 75% that are managing the ESG issues, and that's irrespective of their financial performance. And so we're going to build these indexes, and the good thing we can point to, we haven't talked about performance yet, but the performance is very in line, in fact, a little bit better than the broader overall universe. But then that creates the universe for then the active portfolios, where a portfolio manager who does sort of roll up your sleeve, bottom-up fundamental analysis, the kind of work that Aimee and your team does on behalf of clients, and then you can identify those companies that have strong performance, financial performance, and also have strong ESG performance. And I think that's sort of that nexus which we're trying to isolate, and then you can build a much more focused portfolio on those companies. But just because a company is a strong ESG company but not financially attractive, that doesn't mean it's going to make it into these active portfolios. But the opposite is true. You don't want to sort of bend the rules or allow a really attractive company from a financial perspective that has a lot of ESG risk in it. You don't want to expose clients to that.
Aimee, you have anything to add to that?
I mean, I would say my answer to that question would be we would look for a third company. So we would have the same thought, that we don't want to take a company that we think will grow fundamentally but is weak on ESG factors and expose clients to that just because of that potential for good performance. By the same token, we don't want a potentially fundamentally weak company that's strong on ESG. We may add that to our approved list and reevaluate it down the pike, but we would really just look for a third company that we felt met both sides of the equation.
Aimee, there's this evolution in SRI called impact investing. What is it, and how much do you engage in it?
So I like to say that as part of our research process, we're always looking for impactful companies. One of the things that I always say is that we're really looking for companies that we think we can tell a very good story about. I love to find a company that is very easy to talk to clients about. We often will engage with company managements to find out more about a company's impactfulness if it's not apparent from their CSR report or other research that we can do. We are now also seeing much more in the realm of community loan funds. We've had clients who have invested in farm cooperatives that provide loans to small farmers. So we're seeing much more now in the arena of looking for more targeted, sometimes smaller investments. They do tend to be less liquid, which is a consideration that we really use for our clients, is the liquidity. But it is a growing space. It's one that we've certainly been considering for our larger portfolios.
Maybe one thing I'll just add to that. It's interesting. So we've seen sort of this evolving definition of impact investing. I think when we were early in our careers, impact investing was really private investing, whether it was community loan funds or private equity investments. It was financial return was almost sort of secondary to supporting a project or helping some sort of a green business get off the ground. And private equity and impact investing is probably as more popular than ever, particularly with large institutional investors. But then we've also seen some very large firms out there that have impact investing programs. And they're not just talking about private, non-public investing. They're talking about this whole category. I think you can have impact in sort of your working capital investing, if you will, which is investing in the public markets, investing in equities and fixed income. One of the things that the industry has been focused on, we've been focused on it as well, is generating impact metrics. So you can actually calculate, it's difficult to do, but you can actually calculate some sort of ESG exposures like carbon emissions, toxic emissions, exposure to fossil fuel reserves, tobacco, et cetera. We do that on many of our funds. I'm sure many of the advisors, the managers that you work with are doing that because it's really important to show the clients, that the portfolio is different, because sometimes it's not that clear looking at the top holdings. You were talking about before an ESG index that was an ESG index, but it had a bunch of oil and energy. So these impact metrics, I think it's an opportunity to just be more transparent with investors. But I think you are seeing sort of this evolving definition of impact.
Do you think overall the trend in socially responsible investing has pushed companies to be more socially responsible?
I would say so. I mean, I think you mentioned the word greenwashing in your introduction. I think that's a relevant phrase, because there are companies that are just prettying up their image to look better in the eyes of investors. I think companies out there are competing for capital, and so anything that companies can do to position themselves to attract capital, they're doing. But I do think that one of the things that's interesting about this whole phenomena, so we have an industry group called USSIF, United States Sustainable Investment Forum, and so even the responsible investors have a lobbying group, and they conduct a trends report every 2 years. They add up all the money that is professionally managed in the United States with some sort of an ESG or shareholder engagement or exclusionary approach applied, and they just released the last report this last fall. It's up to $12 trillion, which is actually 1 out of every $4 is managed with some sort of an ESG, SRI approach to it. That is largely institutional investors. It's a lot of the big public plans and foundations and endowments. Some of it is no Sudan, some of it is no coal, some of it's no tobacco, some of it is legislatively driven. But this is really something that's being driven by the institutional marketplace. And we do think that this is going to follow the path that separate accounts, separately managed accounts did back in the 80s and 90s, even the use of alternatives, where they start on the institutional side of things, but eventually individual investors start doing it as well. But I think back to your question, companies recognize that to be attractive in the minds of investors, they have to have strong performance. I think this is part of sort of the compelling notion of this, is that this isn't companies just cleaning up their ESG image to look like they're better corporate citizens. We're looking for companies that are actually profitable. The reality is that we have challenges today in society. We've got environmental challenges, we've got social issues, and there are companies that are stepping up and they're addressing these issues through their products and services, and they're doing it profitably. And so it's identifying. I think our goal ultimately, our organizations, is to try to find those companies that have they're managing their ESG issues in a good way, but they're also profitable. They're making money doing it.
Mm-hmm. We talk about large institutional investors and big companies. A lot of this starts, though, at the top of these companies. We saw Larry Fink, the head of BlackRock, shook things up a year or so ago when he said, after one of the major shootings, we have to be more responsible. We're going to make decisions in our funds about weeding out companies that make guns or sell guns. We have to have an impact on this. How much of socially responsible investing do you think starts at the top with a vision, somebody like Larry Fink or other people who run companies? I
think it very much starts at the top. I mean, Larry Fink is certainly not the first example of that. We've seen CalPERS, the California Pension Fund, for years really focused on ESG issues. We've seen State Street really moving to look at how they vote their proxies for companies that are more sustainable. And so the Fearless Girl statue. The Fearless Girl statue. So I think It certainly does start at the top. I think one of the things that we really like to see is it starts at the top, but it filters down to the bottom. And so we want to see good, committed corporate leaders, but we also want to see the bottom line embracing it as well. You know, when we think about, is this something that's going to be self-sustaining? Is this something that companies will continue to embrace? I think back to when President Trump was elected, and I received several phone calls from clients who said, well, Trump is in office now, he doesn't care about the environment, should I move out of your strategy? And my answer was, well, no, because it's not just focused on the environment, it has far more reaching implications. But one of the other things that I saw was that companies weren't abandoning their environmental initiatives because of what the government was doing. It still ran full steam ahead. And so I think that was an example to me that it is self-sustaining no matter what noise is going on outside.
Any thoughts on that, Anthony?
Yeah, I mean, I would say that Trump being elected has actually been a boon to our business. Our business is up pretty significantly, about 30% just in the last couple of years. And I think it's partly, I think people say, well, you know, these issues are more important than ever. I think there's also the realization that governments and public organizations can only do so much. You know, really for progress, for us to achieve progress on a lot of these issues, it's going to be companies that step up. One of the presentations that we talk about is just all the advancements that we've made in society in the last 200 years. I mean, you go back to the pre-industrial age, you look at life expectancy, you look at the number of people that are in poverty, you look at the number of people that are, you know, that face disease in their life. I mean, the charts are really, you know, incredible. And part of that has been that there have been companies that have worked on these issues, and so it's capitalism, it's competition, it's these corporations that have helped. Obviously, you need regulation, you need a framework for companies to do their best work. But we think that it's going to be companies that step forward and really help to address some of these issues that we have today in society. And so I think that's our goal, is to identify those companies.
It's interesting to hear you say that the election of President Trump actually was good for socially responsible investing. We look at this country politically, we have a shift to the left on a big part of the electorate. You know, we have Bernie Sanders is up there. He's running for president again. Has the shift to the left, in the Democratic Party at least, has that pushed more socially responsible investing at all? Has it had any impact, that political shift, on where you invest and what people are interested in as far as their investments go?
I don't think it's necessarily changed where we invest, but I do think that it has pushed clients to be more interested in an SRI type of portfolio. We've definitely seen that growth.
What do you think, Anthony?
I think it creates the opportunity for there to be some sort of air cover, some wind in the sails of some of the industries that are going to benefit from sort of the greening of society. So I live in Maine. On my drive down this morning, I was listening to, I think it was New Hampshire Public Radio actually, but there was an article, there's a story about New Hampshire, which has had a recent shift basically to the left across their whole, you know, state governor political situation there, and they are working on a proposal to basically be carbon free, you know, generate electricity across the whole state without the use of carbon, without the use of fossil fuels by 2045. And it's a very ambitious goal. You know, it's New Mexico, so they benefit from a lot of sun. They actually have a lot of wind there as well. But they also, you know, the challenge there is that they also have, you know, they have access to the oil fields in the Southwest, you know, on the Texas side, and they actually generate a tremendous amount of revenue. They don't necessarily use the oil and gas themselves, they export it. But to help facilitate this transition to renewables, they're going to need the revenue that's coming from the fossil fuel to do that. And so that's just a little sort of example of some of these issues that are out there. But there are companies that are going to benefit from the move toward renewables, toward energy efficiency, to smarter use of electricity, smart grids, more efficient use of water. And those are the kinds of companies that we prioritize in our portfolios.
We're on a college campus right now, the Center for Ethics in Business and Government here at St. Anselm College. I remember in a few years ago when I was in college, there was a big movement to divest holdings on colleges from colleges and their investments in South Africa as a way to end apartheid. So are we seeing anything like that from colleges now in terms of And Aimee, maybe we could start with you in their desire for being socially responsible as they invest?
I think a lot of it now has moved to climate change, and so what I have seen is universities and colleges moving away from investments in fossil fuels as well as coal. I think those are the two big ones that I have most recently seen.
Yeah,
what have you seen in that area, Anthony?
Yeah, no, I totally agree. So we were actually doing business back in the early 80s when apartheid was a big issue, and I think a lot of us in the industry point to that as a tremendous success because it was not something that you thought about from an investment perspective, but we actually had a policy back in those days to not invest in companies that had operations in an apartheid South Africa. And then we saw the lifting of apartheid and then Nelson Mandela becoming president of that country. Yeah, I mean, you've got the 350.org, Bill McKibben up in Vermont, who really started sort of this whole move towards awareness of investments in the endowments and pressure. I totally agree that fossil fuel is enemy number one in terms of those campaigns. And the way we analyze that whole issue in our own portfolios is, companies that have a lot of fossil fuel reserves on their balance sheet, New Mexico going to renewable energy in the next 25 years, there could be a point where we're actually using a lot less fossil fuel than we currently are. And a lot of these companies have part of their value, part of the market capitalization of those companies is based on those assets. And in a situation of stranded assets where it's not worth it to pull those assets out of the ground because of the market risk, the regulatory risk, the environmental risk, that's a significant long-term challenge. It's not priced into the markets at all today, but it's something that we view as a negative and generally don't have any companies that own the reserves on their balance sheets. So I think you're going to continue to see pressure on that. There have been a few schools that have declared to be fossil fuel free. I think it's challenging. The bigger the organization, probably the more challenging. The lowest hanging fruit has been coal, but I think you're going to continue to see a lot of energy on that going forward, no pun intended.
From a client demand, you mentioned that climate change is the big one right now, at least for colleges and their investments. What are the other issues? When we go workers' rights, there are plenty of other issues out there. What are the issues that clients say, I want my investment to be free of, to be part of? What are the hot button ones right now?
So what I generally see besides the environment is really looking at workers' rights, diversity, looking at the percentage of women who are involved in a business, be it on the board or in executive management, and governance as well. I think we've had a number of examples over the past 2 decades of companies that had very poor governance, and I think people now recognize that is very important to look at how a company is run. Volkswagen is a perfect example of one that we've seen in the past few years where there were many red flags with their governance for many years, and that proved to be a real risk to the company.
Anthony, what are the hot areas right now?
Yeah, I think, well, again, so in terms of how we invest, we're always focused on what's most financially material to a company. But I think if you raise the lens, certainly the issues that you've touched on are front and center, I would say. In terms of the S factors, the social factors, I would say diversity, gender pay equity, board diversity and board representation. I mean, there's increasingly a number of academic studies that point to the value of having a diverse and independent board, senior executives. Gender pay equity is a big issue, so we focus a lot of our efforts on those. In terms of the S issue or the E issues, obviously, I think climate risk and depletion of finite natural resources are big. We do a lot of engagement in our company as well, so we haven't really talked about that at all. But one of the couple of themes that we focused on this last year was the whole civilian firearms issue in the wake of the Parkland, Florida shooting, and then also the opioid epidemic, which is something that obviously is unfortunately right on the radar here in New Hampshire and northern New England. So just in terms of the opioid, it's ravaging our society, right? I mean, more people died of opioid-related deaths a couple years ago than we lost in the entire Vietnam War. I mean, over 60,000 people. So it's ravaging communities and so societies. There's a heavy impact in terms of the S, but that's also risk to the companies that are involved in the manufacturing, the distribution, the prescription benefit companies, the insurance companies. And so we look through that whole sort of value chain, and we make the assessment that there are a handful of companies that just have too much risk, and their performance on this issue has been too bad, essentially, that we won't invest. And then there's some companies that have some exposure and we're willing to invest, but then we're going to engage with them. Engaging is voting your proxies. So if you're an investor in stocks or mutual funds, you have the opportunity to vote your proxies. What do most people do with their proxies? Put them in the trash can, hopefully recycling bin. They don't vote their proxies. Managers usually just vote with management. So we're careful about voting our proxies, always in alignment with our principles. We'll engage with company managements, and we did that with this one particular company. It was a pharmaceutical distribution company in Chicago that had exposure to opioids. We actually filed a shareholder resolution with this company, which was, we put it on their ballot at the annual general meeting, and we said, listen, this company has to formulate a plan. They have to articulate to us, the investors, how they're going to deal with all these lawsuits, all the legal risk that they have associated with being in the opioid business, and that went to vote, and 62% of the shareholders of the company agreed that that was a financially material issue that the company should report on. I mean, that's an unprecedented level. I mean, we'd file resolutions back in the 90s, and if you got 5% of shareholders of a company to respond, that was a big deal. So it passed. It was a majority. And so these issues they're front and center. They're not just ESG issues and social responsibility issues. They're also financial issues. And we as investors, we have a voice and we have the ability to influence companies. And our case to these companies is, listen, be more transparent. I think it was Mark Twain who said sunlight is the best disinfectant. Sometimes we're just looking for more information, right? Because then we can make an informed decision. But push forward on these issues to try to get a company to be better positioned and potentially more profitable.
Mm-hmm. Are there any companies out there, and maybe we can start with you, Aimee, who you hold up as saying these guys are doing it right as far as ESG goes?
So it can be difficult to pinpoint a company that is doing everything right. One of the things that I find as I do company research is that every company has an issue, something that is material to their performance and their ESG parameters, and we have to make the decision, is it too material?
Nobody's perfect.
Nobody's perfect. We see many companies that have done a lot with their environmental issues, becoming much more energy efficient, looking at recycling company-wide. We see a lot of companies that are coming out with, as Anthony had mentioned, products or services that really address some of the issues facing society today. We also, governance is a big thing for us, and so that's an area where we see many companies really moving to have more women on the board. It's very rare now to see a company that doesn't have at least one woman on the board, which when we first started in this industry, I think was not always the case. So it's really hard to pinpoint a specific company. I don't know if you have a specific example.
Yeah, well, on the board diversity, 15, 20 years ago, it was hard to find a company that didn't have some gender representation, diverse gender representation. Now it's hard to find a company that doesn't. But we're still far from the ideal solution. So we're part of the 30% Coalition, which is an investor coalition that strives to make sure that every board in America, at least the S&P 500, 30% of the board is gender diverse, which is generally adding more women to a board. There are clear economic and financial benefits to the company. Yeah, I think I was just looking at our top holdings in our large cap index. Apple and Microsoft are at the top of the list, not just because they're huge companies, but also because those companies are distinguished in their development of particularly programs. So both those companies are essentially carbon neutral. In the technology sector, they use a lot of energy in their data centers. They've invested in a lot of renewable energy. Apple actually introduced one of the first green bonds a few years ago to partially fund their environmental sort of projects across the company. I think like you say, no company is perfect. This is responsibility in the investment context, and we always sometimes get pushback from clients to say, well, look at some of these companies. Are these really responsible companies? If you want to build a diversified portfolio, you need access, you need representation in most of the sectors. But again, there's enough data out there that you can identify the best companies. And there are still companies that are laggards in their sectors, in their industries.
Are cannabis companies interesting to you at all? I mean, it's a new industry. It's
Yes.
happening a lot in Massachusetts and in other parts of the country, and
Yeah.
companies are springing up all over the place looking for money.
As far as I know, the only publicly traded ones are Canadian,
Okay.
right? That's
I
been the
believe
case.
so.
And so obviously, cannabis is now legal in a number of states, but it's still not legal federally. So that's a big headwind from an investment perspective. So when we analyze companies, we're really looking at sort of three things, and I'll dig a little bit into the minutia, but still try to keep it high level. The first thing we're trying to evaluate is how is a company's policies and procedures set up to sort of theoretically ensure strong management of ESG issues, and that's something that we can score numerically. We then consider their circumstantial performance, which is, are there controversies, are there lawsuits, are there data breaches, is there some bad news that has come out on the company that maybe reflects that the company might have all these policies and procedures, but they're actually not that successful at implementing those policies. And then the third thing we consider is what is the impact of the product that the company makes, both on society and on the environment. And that's where we will look at civilian firearms manufacturers, companies with a lot of fossil fuels, tobacco, alcohol. You know, there's some products where they have a heavy impact on society, and there's not a lot of optionality for that company to get out of that business and go do something else. And we would be concerned about cannabis from a product impact factor. I think we just don't know the long-term effects of that being legal, you know.
I want to follow up on something with Aimee. You mentioned we were talking about women on boards. You still work in a field that is dominated by men, mostly men. And I'm wondering, do you think that women have a better eye for socially responsible investing than men do?
I don't know if I want to make that argument. It is pointed out quite a lot that the SRI team at Cambridge Trust is all female. So we've had one intern that was a man, but he was only around for a few months. So.
And why is that?
And it's
He
really
didn't last
just,
long, huh?
he didn't last, no. It's really just worked out that way. I don't think that's something we've really done deliberately. You know, I think I really ended up in the industry because when I started at Cambridge Trust, I did not have a background in fundamental analysis. And so I think at that point, they weren't quite sure what to do with me because everyone else was pitching stocks, and I just didn't have that background. And so when we had clients start asking for social investments, that came my way.
And you went with that.
And I went with that, and I found it very interesting in an area that I could really grow in an area of growth. And so, you know, it was just something that I found I could really embrace. I do think the investment industry has a ways to go as far as having more women interested in financial or investment careers, but it's come a long way since I started in the industry.
I had to put you on the spot about that one. So what are your thoughts on this, Anthony?
On the whole gender?
Yeah.
Well, I mean, if
whether women have a better eye for socially responsible investing.
I mean, for many years, it's probably still the case. The majority of our shareholders, I mean, and Calvert is a responsible investment manager, the majority of our shareholders are women. I think when you look at the demographics, there are two demographic groups that come up, you know, and you ask them, do you have an interest in responsible investing? Do you own responsible investments? When you look at all the different, you know, going all the way back to the silent generation, and I'm not going to get all these, right, the baby boomers, the Gen X, the millennials, you know, and then men, women, the highest bars on those charts are always women and millennials. But I think, you know, again, this goes back to sort of how you're positioned. If you talk about it in the contemporary sense, that we're really just trying to evaluate how companies are managing their financially material ESG risks, and you look at the performance, I think this can be an attractive investment approach for everybody. But I think for some of those reasons, you know, there's been sort of outsized interest with women. I think you're seeing in our industry tremendous product proliferation. There are companies now that are doing responsible investing that have never done it before. In fact, you know, probably said they would never do it. And so we're always encouraging investors to consider sort of the sincerity, because there are companies that are just seeing this is the next investment boom, and we want to make sure that we're out there with some products to pick up some market share. I think it's important to consider those companies that have a good methodology, they have a good approach, like you say, lift up the hoods to see what's happening, but that we're also sincerely interested in finding companies that are working to make the world a better place. We sometimes think about how, you know, companies have impacts, they're making impacts, they have positive impacts, they provide employment, contribute to healthy economy, can make communities stronger. But companies also have negative impacts. They use natural resources, sometimes have pollution, they can have negative impacts on employees. You know, our job is to balance these impacts and ensure that we're investing in companies that are offering a net benefit to society. And I think that's something that can be attractive to all investors.
You know, I had a student ask me this question the other day in my class, and we were talking about socially responsible investing, and he said, do you think companies do this because they want to or because they have to? And I thought it was a great question. Do you have a sense of that?
I think it's a bit of a mix. I think there are...
That's what I told him.
Yeah, I do believe there are companies that truly want to improve society. They want to address the problems of society. And I think there are many companies that recognize that it's a way to make them more sustainable into the future. You know, one of the things I see now is that many energy companies are making more and more investments in renewables. And I think a lot of that is a nod to the idea that we will move away from fossil fuels at some point. And in order to survive into the future, they have to go in other avenues. I do think there are many companies that do say, okay, this is something that I'm going to be asked about. This is something my shareholders are going to care about. And so we are going to have to step up and do a CSR report and try to embrace this. I think this is where the deep analysis can really pinpoint what companies are sincere versus which are just sort of greenwashing to look attractive.
Do you have any thoughts on that?
Yeah,
The motivation, the why?
Maybe just to build on what Aimee said, I think that I feel like years ago, companies said, well, we should probably do this or that because it's going to be the right thing to do. It might be an economic sacrifice in the short term, but you know, I think our investors, our shareholders, our employees are expecting it. But I think the light bulb is starting to go off in corporate boardrooms, and they're recognizing that if they do some of these things, they actually will be rewarded in the marketplace. And I'll just, maybe I'll share a quick example. So in our small cap strategies, we'll invest in small companies. And the reality is with small companies is that they are typically, they're just busy running their business. They don't have a director of corporate responsibility. They don't have time to put out a fancy corporate sustainability report. They don't have time to complete the questionnaires that come from the ESG data providers. They're just busy on their business. If you look at the ESG scores of small cap companies, sometimes they are penalized for just a lack of disclosure. And again, they just don't have the time to report on their carbon use, carbon emissions, and their energy use. And so we will actually use that as an engagement opportunity, and we will, we will look for controversies and do as much research as we can on a company. But then we'll contact them. We'll say, listen, you should start disclosing more because there's an economic benefit from being more transparent about your business because your ESG scores are going to increase, and then that's going to attract more capital. And that's probably going to have a positive impact on your stock price. And so I think company managers are starting to get that.
I think it has other benefits too. It has reputational benefits because your overall reputation might increase as far as public awareness goes. And there are many younger people who want to work for a company they view as ESG friendly.
I would say that's true.
Yeah, yeah. Do you see that at all? Do you have any thoughts on that, Anthony?
Yeah, we actually have. I don't know if it's on our website, but we actually just wrapped up a white paper on this, again, in connection with the Harvard professor, that basically looked at a purpose-driven organization. And the analysis that they did is that if a company has a mission, more than just making a widget and making the most profits as possible, but if you can point to something that the company is doing to actually address a pressing societal or environmental issue, that actually motivates. That's a source of motivation for the employees, and the employees are more engaged, and the companies actually are more successful, more profitable than companies that don't have sort of that, greater cause, if you will.
There's even, I think, a movement to say that CSR per se is no longer a relevant term, that now a company must have a corporate mission or purpose that transcends corporate social responsibility.
I think
essentially is what you're saying.
Correct.
Yeah, yeah.
I think so.
All right, I want to get back to just a little bit about data. You've both mentioned data so many times. How important is it? What kind of data? We've all, big data can mean a lot of things. How do you use it? How do you evaluate it? Do you trust it?
Well, the thing that has become much more challenging in recent years is the prevalence of data. It's everywhere. There's different providers that provide it. some of the analysts laugh at me because I will often just Google a company just to see what I find. I use that in particular to try and ferret out a controversy with a company. And we really believe that you have to look at the raw data. I mean, most of the major providers will do some sort of scoring, and we have a hard time really taking that scoring at face value. We like to look under and see the actual raw data, what sort of disclosures a company is making, to make our own evaluation. We will often use that as a way to engage with the company to get more data out of them. We often find that many, particularly small cap companies, don't disclose as much as they should. The data is just not there, and so it's a way to engage with them.
How do you collect the data? Do you do it yourself, or do you have someone else do it for you?
It's a mix. So we subscribe to a service provider, MSCI, that provides data to us as well as scoring. We do a lot of our own work. We use our fundamental analysts for some of the work. Some of it is just going to the company's website, talking to the company, going online to see what you can find. The data is everywhere, so it's just a matter of finding it.
Anthony, how does the way you do it compare to, because you guys work for different entities?
Yeah. There's some commonality though. So we have, we actually manage 27 different strategies. So we've got a lot of different investments in lots of different markets, US, non-US, emerging markets, fixed income. And so we need, that's partly why we built sort of this quantitative system so that we can really score companies and create a big investable universe for our portfolio managers. And so we use a lot of data. There are about a dozen different data providers that we use. So MSCI is probably, I would say, the market leader. They've grown by acquiring other smaller ESG data providers and have done that very successfully. Sustainalytics is another very prominent company out there, but Thomson Reuters has data, Bloomberg has data, ISS, Institutional Shareholder Services, is a proxy voter. They've got data. There's True Cost, True Value Labs, Rep Risk. I mean, there's a ton of them out there. GRESB does real estate ESG ratings. Maplecroft does sovereign ESG ratings. So we spend a lot of our time, and we have a pretty big analyst team in our office down in DC, and they're just sort of combing through all these data providers because there is a lot of noise in the data. So I think through all the different data providers, we use about a dozen. We have access to over 4,000 performance indicators, KPIs, but we end up at the end of the day, only using about 300 of them. And so part of that is sort of the quality control. Part of that is we don't think the data at some of these providers is as good. There's also this issue of correlation. So sometimes MSCI and Sustainalytics don't have the same outcome on a company. Surprise, surprise. What's interesting about that is that that's not necessarily the case if you look at like credit ratings. If you look at like Moody's and Fitch and Standard & Poor's for like bond ratings, there tends to be a fair amount of consistency in those ratings. So part of that is that we're just, it's a nascent field. ESG reporting is not mandatory. There's actually an organization called the Sustainable Accounting Standards Board, which we're a close collaborator with. They're attempting to do with ESG data as FASB did, Financial Accounting Standards Board, to financial data. So make it a mandatory exercise. Make sure that there's uniformity in terms of how these issues are disclosed. So the good news is that the ESG data front is way better than it was 10 years ago. Still has a long ways to come.
A couple more thoughts before we turn it over to you guys. So you have all this data, you make your decisions, you make your investments, and then at the end of the day, how do you measure success? That I have been and done the right things as a socially responsible investor.
So when we think about our socially responsible clients, we actually think that they're looking for two things. They're looking for the financial performance, and we have found that the myth that you give up investment performance in order to do good is just that, it's a myth. It's not played out in performance. If you look at the major indices versus an ESG index, it's not played out. But we also find that our SRI investors are looking for that social performance. And so we actually have a marketing page that looks at just financial performance versus financial plus the social. And so we think that that's how they're measuring their success, is they've got the financial performance, but they also have that social performance that's more in line with their values.
How do you measure success?
Yeah, I mean, very similarly. So we're an investment company, and so, having competitive investment performance is critical. I think we've made tremendous progress, really as an industry. I mentioned, this index that we've created of the 750 best of the 1,000 companies. That's actually outperformed the traditional benchmark by almost 0.5% over the last 10 years. So anybody who thinks that you can't perform, that performance is sacrificed in these, they just haven't looked at this recently, closely. Also the opportunities to diversify. The issue for years is that, well, this is great for investing in large US companies, but what if I want, international companies and emerging markets and fixed income? You really can find many options out there. I think Morningstar, which is a very popular, mutual fund sort of analytic company, a tool, they've got about 350 mutual funds now in the space that do some sort of ESG and responsible investing. So there's the financial performance, but totally agree with Aimee that you have to be able to prove the impact or the ESG performance as well. That has really been very difficult up until the last couple of years. It's largely been anecdotal. It's that, well, we engaged with this company and this was the outcome at their annual meeting. Or, we don't own any of these oil companies or these tobacco manufacturers. But now, because of the data's gotten a little bit better, we can produce these impact metrics. And so I encourage anybody to look into this. On our website, we have all the impact metrics. In fact, we have an impact tool that allows you to not only see that in some of our portfolios we have half the carbon emissions, 75% less toxic emissions, no exposure to tobacco, no exposure to fossil fuels, we use less water, we produce less waste in our portfolios, but then we allow you to convert that into, okay, lower carbon emissions means that the portfolio is consuming less gas, which is the equivalent of thousands of daily commutes that have been taken off the road. So we try to make it a little bit fun, kind of an interactive tool to see that. So I think it's financial performance and then having some impact metrics so the clients can see how they're exposed.
So briefly, before we go to questions, we're long past the time, obviously, when people thought that socially responsible investing and making money were mutually exclusive. So let's look forward. What's the future? Where are we going over the next 1 to 5 years as this bus goes down the road and it appears that we're going to see nothing but expansion and growth in this area?
I think one of the things that we'll see is better standardization of data. I think that's been a bit of a challenge for the industry because you've got so many different providers. As Anthony said, 2 different providers, MSCI and Sustainalytics, they won't agree on a company. That's one reason we don't really use the scoring. We look at the raw data because we want to make our own decision. So I think as it continues to become more mainstream and the data providers can standardize, I think that's an avenue of growth that we'll see. I think that is something that will help ESG parameters become a part of fundamental research. That's something that we're seeing even on our own investment process, is that our fundamental analysts, as we can standardize and show them some exact metrics that we can pull off of Bloomberg, they're starting to include that in their research. And so I think that that's an area of growth, is just to have it be more all-encompassing of the research process.
What do you see in the immediate future, Anthony?
One of the questions that we get is, if everybody starts doing this and if all the companies have better ESG performance, is it just going to sort of relegate ESG or impact and responsible investing to something that's not important? I think we will continue to see sort of the tide rise and overall ESG performance improve because it's what investors are expecting, but I think you're still going to be able to identify companies that are doing a better job than other companies. And so I think there's always, hopefully, a business there. But I think you're also going to see the ability to do greater customization. So you're starting to see this on the institutional side of things, and I think in time it'll become more available for individual investors as well. So we've recently developed a portfolio for an aquarium, and the aquarium wanted a portfolio that was centered around ocean health. And so we customized our environmental analysis for plastic, because we know that plastic ending up in the ocean is a huge issue. Pesticides and agricultural runoff. And so they weren't necessarily as focused on the G or the S. We really focused on the E in this particular and created this sort of custom mandate for them. I think you're going to see with technology, I think you're going to see greater ability for investors to really customize around issues that are a priority to them.
Everything's becoming customized these days, from medicine to investing.